Right now, almost everyone believes the Fed is about to cut rates in September. Odds are sitting near 90%. Investors are already pricing it in. And the market is celebrating like the decision has already been made. But that's exactly the danger. Rate cuts are not free money. They are signals. Signals that something under the surface is breaking. And whether the Fed delivers the cut or pulls back last second, the damage is already done. The rules of the game have shifted. Most investors won't see it until their accounts are bleeding because they confuse policy shifts with certainty. But certainty doesn't exist in markets. And when the floor moves under you, the difference between panic and profit comes down to whether you were prepared or just following the herd. The stock market is acting like this is business as usual. It is not. When odds of a September cut shoot up to 90%, you are no longer in the same game. The cost of money is about to change, and when the cost of money changes, every asset in the system gets repriced. Look at the evidence. Treasury yields dropped the moment Powell opened his mouth. Equities ripped higher, Bitcoin spiked. That is not a coincidence. That is liquidity flowing in anticipation of easier policy. But here is the part most investors miss. When the Fed tilts the board, your old playbook stops working. The takeaway is simple. If you are still investing like rates are staying higher for longer, you are already playing the wrong game. The Fed just reset the field, and those who adapt fastest will win. Most people hear rate cut and think it's a green light to buy everything. Wrong. Cuts don't mean safety. They mean stress. The Fed doesn't pull this lever when the economy is roaring. They do it when pressure is building. History proves it. Rate cuts often line up with recessions or with markets trying to shake out excess risk. In the short term, stocks pop, but the whiplash comes fast. Investors chase the rally, then panic when the data turns south again. That's how portfolios get destroyed. The truth is this: cheaper money doesn't erase problems, it just moves them around. And if you're chasing every bounce without conviction, you're the problem the market feeds on. And not every stock wins when the Fed cuts rates. Some get a tailwind, others take a hit. This is where most investors get blindsided. Growth companies, especially tech, they benefit first. Lower rates mean future earnings are worth more today. That is why high-growth names like NVIDIA or Palantir can swing so violently when the Fed shifts. At the same time, financials often take a margin hit. Cheaper money compresses their spreads. Commodities, gold, and even crypto, they rally when the dollar weakens and liquidity rises. The takeaway is simple. A rate cut is not a rising tide that lifts all boats. It's a storm. Some ships catch the wind and fly. Others take on water and sink. If you don't know which boat you are on, you are gambling, not investing. Here's the hard truth. You're paying premium prices. The S&P 500 is near 29 times forward earnings. The long-term average sits closer to 17 to 18 times. That gap is massive. The last 3 years prove it. 2023 finished up 25%, 2024 added 22%, and 2025 is already up 9% year to date with months still left. That pace is not normal. That's expensive. A rate cut can push valuations higher, but it also makes the system fragile. At 29 times, one earnings miss, one weak guide, one margin slip, and you get punished hard. If you buy here without conviction, you're not investing, you're gambling. The takeaway: only pay up for companies with profits, real revenue growth, and durable free cash flow. Everything else is overpriced noise. Most investors do not get hurt by crashes. They get hurt by panic. The cost shows up when they sell low, then miss the rebound. You can measure it. Here is the side-by-side. Fully invested for 20 years, $10,000 grows to about $65,000. Miss only the 10 best days, about $29,000. Same market, same index, different behavior. That gap is the price of fear. Look at 2022. NVIDIA sat near $108, Palantir near $6. People bailed. The investors who held their thesis watched those positions recover and run. The ones who sold bought themselves permanent losses. The takeaway: conviction pays, panic taxes your future. You see, a storm always exposes the truth. Weak companies sink, strong companies survive, and the survivors come out stronger because the competition gets wiped out. We've seen it before. In 2000, junk internet stocks died. In 2008, over-leveraged banks collapsed. In 2022, hype names with no cash flow got crushed, while NVIDIA and Palantir dropped hard but came back swinging. Rate cuts don't stop storms. They set the stage for them. So here's the lesson. You can't control the storm. You can only control the boat you're in. Profitable companies with real revenue and free cash flow stay afloat. The rest, they risk disappearing. The takeaway, don't ask if a storm is coming. It is. Ask if your portfolio is built to survive it. So here's the lowdown. The next rate move will create winners and losers, not because of headlines, because of behavior. Investors with conviction keep their seats when the table shakes. Investors without it donate their gains to the market. I felt it in my own account. $350,000 drawdown in days as Palantir and NVIDIA dropped hard. I did not flinch. I'm recovering, although not fully recovered yet. That matters. I can sit through pain because I know what I own. Profitable companies with growing revenues and free cash flow survive storms and take share when weaker players fold. That is why I hold. That is why I still sleep at night. The path is simple. It's not easy. Build a thesis you believe in, own businesses that print profits, grow the top line, and throw off cash. So here's the decision in front of all investors. Panic and chase every bounce, or pick a few quality companies, learn them cold, and hold through the noise. One choice trades feelings, the other compounds capital. Profits, growth, cash flow. If you own that, you can take a hit and keep moving. All right, the proof first. Wreaks Havoc banked $7,998 on PLTU, up 8.42% in one day. Real position, real execution. That is what discipline looks like when markets snap. Now I have over $5 million in the market. Year to date, my accounts are up $1.9 million, which is about 55.53%. I also ate a $350,000 drawdown when Palantir and NVIDIA dropped. I didn't flinch because I know what I own. Recovery is underway and I'm not worried about it. That is the truth. And here's what you get inside my Patreon. Real-time alerts with entries, exits, and the reason. Daily market notes that cut the noise and focus on what moves price. Weekly deep dives on companies with profits, real revenue growth, and free cash flow. Position sizing and risk rules so you can survive pain and keep compounding. And here's a price check. It's only $30 a month. On a $30,000 account, a 0.1% improvement covers that. One better entry, one cleaner exit. That's the math. No promises, just better decisions. Gurus sell instant success. We train investors. If you want signals without skill, this is not for you. If you want to build conviction and execute under pressure, join now. Cancel anytime. Of course, the results vary. This is education, not financial advice.